Good evening. David Boster here from SCORE Bucks County. Welcome to our Wednesday webinar. Tonight we are talking about where's the money and talking about today's lending environment. One or two quick housekeeping type things. On your screen is a box where you can type out a question. So during the presentation, if you have questions, just type them out and I will see them. And our typical procedure is we address those questions at the end of the more formal presentation. We are recording this, so yeah, I know some of you may want to take notes, but if you miss something, don't worry, because it'll end up on YouTube, and I will send you a link for that in the next day or two. All right, so we are ready to go, and we're very, very fortunate tonight to have as a speaker Eric Schachterman, who is a director of sales and marketing at a national company called Benetrends. Benetrends is a financial lending institution, and obviously Eric's here to talk about it and talk about ways in which you can find financing for an existing business or a startup business. So rather than listen to me ramble on, we'll turn it over to Eric. Eric, the floor is yours.
Thank you very much, sir, and thank you for everybody joining us this evening or listening at a later date. It definitely takes commitment to learn about the different when pursuing a business or looking for options for your existing business. And we love working with SCORE. We work with SCORE all throughout the country. Love our SCORE relationship, and as a Bucks County resident myself, I'm very fortunate to be able to speak with everybody tonight about what Dave mentioned, today's current lending environment, and more importantly, where the money is. The lending world has gone through dramatic changes over the last 10 to 12 years, from going back when everybody was using home equity loans because they had a lot of equity in their houses, and then we had the financial meltdown, and that has pretty much ceased to exist, but has had some comeback over the last few years. Then we have the creation of something referred to as crowdfunding that has become that increased in popularity. And then there's just some more traditional funding programs that are out there, from having the ability to use retirement funds or an SBA loan or a securities-backed line. The most important thing that everyone needs to take away is that there are virtually 15 to 20 different ways to get funding for an existing business, for a new business startup, and many of them can work by themselves or together to get you to your total project cost or total funding needs. While we don't have time to go through all of those products this evening, I am going to touch base on some of the most frequently used funding programs that we at least see at Benetrends, as we've been servicing the small business community for over 30 years and work with entrepreneurs all throughout the country, and obviously specifically in the Bucks County area. But just so everyone knows, this is not going to be about Benetrends. The most important thing is that you feel comfortable with some of the different lending programs that are out there for you to learn more information about. To get started of talking where the money is and about the lending environment today, I thought it would make sense to start off with the program that is probably used most frequently in the small business arena, and that is going to be an SBA loan. So an SBA loan is a great program that has been around forever, but has really grown in popularity over the last 3 or 4 years as banking institutions have recovered from the financial meltdown of 2008 and 2009. The SBA program, a lot of people confuse it to where the SBA is a division of the government. It is a government-backed program. It is not the SBA that's actually lending the money. The way the program works is that there's banks throughout the country that participate in the SBA lending program. And by doing so, the SBA guarantees a certain percentage of whatever loans the bank gives out through the program, making it less risky and absorbing some of that risk for the bank, therefore motivating them to put more money out there in the small business community. The 7A loan is the most common SBA loan for business startups and existing businesses. The maximum loan amount on an SBA loan can go up to $5 million. That being said, a lot of people think that because they don't have a big enough business idea, whether it be an existing business, a new business, or purchasing an existing, they get deterred to go after an SBA loan because they think they don't have this $1 million idea or $500,000 or all the way up to $5 million, where in fact, SBA loans can start as low as $50,000. There's a program out there. It's got a number of different names. Some call it the fast track loan. Some call it the express loan. What you need to know is, most importantly, there are banks that are out there that will do SBA lending from 50 to 150. Some have more of a threshold from 150 to 350. And then once you get over that 350, $500,000 range, you sort of open up a full repertoire of banks. But there are programs out there, and in fact, most of the SBA loans that we see in the small business environment typically range between that $100,000 to $300,000 range. Currently, the maximum rate on an SBA loan is prime plus 2.75. So prime, last I checked, is 3 3/4. So the maximum interest rate is 6.5%. So that is always the maximum that is set by the SBA. It cannot rise above prime plus 2.75. That being said, that is not the only interest rate that's available. Depending on the deal that you're looking for, the amount that you're looking for, that rate can go down to the 6 level and sometimes below the 6 level. Low size and the assets part of the business. When pursuing an SBA loan, the way the program typically works is the bank is going to lend you 70 to 80% of whatever the total project costs are. And then they're going to look for you, the business owner, that entrepreneur, to come up with the other 20 to 30%. So for example, if you're looking at a total project size of $300,000 and the bank wants you to come up with 25%, you're going to bring $75,000 to the table, and then you'll be receiving a loan on the remaining $225,000. Now, very different than getting a mortgage or on a home, it's not like you're bringing that $75,000 and actually paying it to the bank. That $75,000 is what's referred to as an equity injection. For lack of better words, your skin in the game. What money have you put into the business? Whether that be franchise fees, whether it be the acquisition of a building, whether it be just the money that you brought to the table in starting the business or buying the existing business. So really any out-of-pocket money that you've spent all gets grouped into that equity injection, and then you will receive a loan on that remaining 70 to 80%. Now, the typical requirements that the SBA environment is going to look for from a borrower really don't change much from any other forms of lending. It is a lending-based decision, so credit score is going to be a factor. I would say the minimum we see in today's lending environment is a 680 credit score. If you're under a 680, there's pretty much not an SBA bank that is going to have interest in your package. From 680 to 700, you are not disqualified, but that also does not mean that banks will have an appetite for your loan package. It'll probably just set the tone to maybe make it a little bit more difficult or make you require to inject a little bit more money or collateral into the business. The most important thing to think about when pursuing an SBA loan is a topic referred to as post-closing liquidity. So what that means, and again, this isn't something that banks will market on their front door. It's not really posted on a lot of blogs or websites, but it's the reality of the lending world today. What post-closing liquidity refers to is how much money do you have left over after you've closed on your loan. So if we go back to our previous example, if a borrower says, I have $75,000 of my own money, and that's the only money I have that I'm going to bring to the table for this $300,000 project, and I want the loan for the remaining $225,000, and they have a great credit score and all the other aspects that the bank's looking for, most likely they are going to get turned down. And the reason for that is that the banks do not want to lend money to people that after they've made their equity injection to get the loan, they have no other money to live off of. So personal living expenses really need to be shown that they can be covered outside of the business that you're funding. A good rule of thumb is take a look at your personal living expenses, and you probably want to have a reserve of about 6 months worth of personal living expenses to show that after you make your equity injection and get the loan, you still have 6 months worth of money to cover your mortgage, car payments, your insurance, all your other bills. Because what the bank doesn't want to see is that the proceeds from the loan are being used to cover those personal living expenses. We talked about some of the eligibility requirements on the credit score. Again, 680 or higher. Transferable management skills. That's a pretty interesting topic today. If you go back 10 years ago, what a bank wanted to know is, what experience do you have in this business that makes you an attractive candidate for a loan? So if I'm opening up a haircut business, they want to know, how many haircuts have I done? Or what experience do I have there? It's very different in today's SBA world. They're not as much concerned with direct industry experience. What they want to know is, what skill sets do you bring to the table that will be transferable to this business? So do you have sales experience, and are you starting a business that's going to be very focused on sales? Do you have marketing experience? Do you focus on have you hired and trained employees? Do you manage a P&L report and a budget? All of these things that can transfer over to your business is what's going to make you more attractive to the banks. You're typically going to have to provide collateral. In most SBA environments, they're going to look for all available collateral, which most likely will be the primary residence. We talked about the 20 to 30% down. Going to get an SBA loan as well requires a decent amount of homework. The SCORE offices do a great job in assisting clients with business plans and projections. You'll have to have an updated resume, get together a personal financial statement and 3 years of tax returns. So it can be an arduous process, but when run properly, it is a tremendous resource for a small business to secure lending. And it's always good, whether it be an SBA loan or any lending decision, to always focus on the 5 C's of credit. And that is character, capacity, capital, conditions, and collateral. So character, that goes to your past payment experience. That's that credit score. Capacity, your ability to repay that loan. Capital, that's your equity injection, that owner's investment in the business. The conditions, the intended purpose of the loan, and the economy. That's really going to come out in that business plan and projections. And collateral, what assets do you have to secure that debt? Another thing to think about when going for a loan, whether it be an SBA loan or any type of traditional forms of funding, is that banks have different credit boxes and different appetites. Best way to explain it, some banks like chocolate, some banks like vanilla. You can bring the best deal in the world that tastes like chocolate to a bank that prefers strawberry, and they're going to turn you down. And it's not going to be based off of your projections. It's not going to be based off of your credit score. It's not going to be based off of any aspect of the business. It's going to be based purely on the fact they just don't have an appetite for that loan. So some banks like brick and mortar businesses where there's actually a building up that's running the business out of it. Some banks prefer home-based businesses. Some banks like specific industries, like a haircutting place. Some banks like a service-based business. So all of these things really come into play. The day and age of walking into your local bank is really becoming more challenging because if that local bank doesn't have a preference for your deal, they're going to turn you down. And when they turn you down, they don't tell you why. They're not going to sit there and say, sorry, this just doesn't fit our credit box. What they do is they just deny your loan. And then you're left there wondering, maybe I don't have an idea. Maybe I shouldn't be an entrepreneur. Maybe this business I'm looking at isn't good. You know, even fast forward a little further, there's also banks that they have buckets. So while these banks do have appetites for specific businesses, those business ideas can also get full, for lack of better words. So one bank might love a specific industry so much that they've already hit their lending threshold for the year for that industry. So you might be the next business owner that's looking to open a business in a specific industry, and you walk into the bank that has an appetite for it, but they already have hit their limit of what they want to lend, and they're going to turn you down because they just don't have room for your loan anymore. And once again, it's not like they are going to tell you that's why. They are just going to deny your loan. So it's really important today to utilize all of the resources that you have to make sure that you're getting to the banks that will have an appetite for your loan and have room for your loan. What are some of the common challenges that people see when they're going for an SBA loan or really any other type of traditional lending? We talked about that post-closing liquidity. That is having enough money left over after the loan is closed for you to cover your personal living expenses. If you're looking for a franchise, you know, when you're looking for a franchise, you're going through a very specific process where you're going through discovery days, you're trying to decide if you're going to sign off on the agreement, but you have not typically gone to get an SBA approval yet at that point. So sometimes some of the hurdles is lining up those two timelines together. Real estate is always going to be a challenge. A lot of times to close on an SBA loan, you need to have your lease signed if you're doing a retail space. So going out and having a search, all that acts. We talked about the business plan. Fortunately for everyone on the line, you know the resources that are out there with SCORE, but the business plan and business projections, it is hard work. It does take time to sit down and really put together a good business planning projections. Also, if somebody's leaving a job or unemployed looking to start a business, that post-closing liquidity becomes more important than ever because you don't have any other stream of income that's supporting your personal living expenses. And then just communication and expectations. The SBA world, it's not fast. So if you go in with the expectation of, here's my business idea, let me know tomorrow if I'm going to get this loan done. The typical SBA loan process, I would say, takes anywhere between 30 to 45 days in an absolutely perfect world with all I's dotted, all T's crossed, and that's after the package is submitted, not even including all the time spent putting it together. So it's a couple of month process. As I said, I'm really not going to go over too much of the Benetrend services. We help our clients with SBA loans, but that's not what tonight's call is about. More importantly, work with professionals that can help you identify what your best resources are out there for an SBA loan. Because what you want to do is find those banks that have the appetite, find those banks that have room for your loan, and then get multiple banks involved in the deal so you can create some sort of a bidding war so that you can pick the best loan terms and options that are available to you. A typical term on an SBA loan is going to be 10 years, What's nice about that term is that there's no prepayment penalty on an SBA loan. A good start with getting an SBA loan is getting pre-qualified. For many of you that are listening tonight, you've probably gone through the process of purchasing a home, and you've probably gotten pre-qualified for a mortgage. As you remember, that wasn't a commitment to lend. It wasn't guaranteeing you that you would get a mortgage, but it would at least tell you what type of house you should be looking for or what development you should be looking in. That's really what a pre-qualification should be. There's a number of different tools that are out there. Online tools, SBA assessments, a company called Bullfly, there's an SBSS score, a number of different tools from on the Benetrend site to on the SBA site, all different things that can give you a good idea of what type of loan you could probably expect. But just be careful on what you do with those results. As I mentioned, they are not a commitment to lend. They are typically, for lack of better words, going to tell you more that you're not disqualified and less about here's the exact amount of funding that you can expect. So moving on from SBA loans, I want to talk about another product that has really grown in popularity over the last decade and really over the last 2 or 3 years. It's referred to as rollovers as business startups. Now, while it's become more common than even an SBA loan, if you look, say, specifically in the franchise industry, it's still a product that is very unknown in the lending world today to the common person up and down the street. But believe it or not, it is a program that has been utilized over 12,000 times, at least specifically with our company, in the past 3 decades. And it allows an individual to access their retirement funds, any type of funds that are in a 401k, IRA, a thrift savings plan if you're a military or government employee, any type of qualified plan that you would usually run into paying tax and penalty on. You can avoid that as long as you're using it to start a business. So let's look at the example if I were to pull that money out in the traditional process that people are familiar with. So in this example, I have $200,000 in my 401k with my previous employer or in an IRA, and I pull that money out. As many of you probably know, you're going to end up paying a 10% early withdrawal penalty, and then that money that I've pulled out actually counts as income for me for the year. So it's going to be on my income tax. I'm going to pay income tax on that money. So in this example, I have $200,000, and after the tax and penalty, assuming I'm in a 30% income tax bracket, I'm going to end up walking away with only $120,000 of the $200,000 that I had saved up in that retirement plan. $80,000 gone to penalty and tax. So not the most attractive way to gain access to funds. So let's look at an example. What if you were working for one company? Let's say I worked for Merck, and then I decided I'm going to go work for Johnson & Johnson. And I had my 401k at Merck, and I'm now going to go over to Johnson & Johnson 401k. So I take my same example, $200,000, and roll it over to my new employer's retirement plan. As I'm sure many of you know, if you've ever gone through that process or moved money from a previous employer's plan to an IRA, you never pay any taxes or penalties to do a rollover like that because the money's moving from one plan to another. So keep that picture in mind of going from one company to another company and moving funds from one plan to another. Now, whether working at Merck, Johnson & Johnson, or most employers that offer retirement plans, there's different types of investment options within that retirement plan. One of the common investment options is the ability to purchase company stock through that retirement plan. So if I was working at Merck or Johnson & Johnson and I log into my 401k online and I look at my different investments, you know, stocks, bonds, mutual funds, and then there's Merck stock. You know what? I'm going to put 100,000 of my 200 in stocks, bonds, and mutual funds. I'm going to put another 100 in Merck company stock. So my retirement plan essentially buys $100,000 of Merck company stock that my retirement plan now owns, however many shares it could purchase. And what a lot of people don't realize is that that $100,000 that my retirement plan used to buy those shares, that literally goes over as cash to Merck. It goes right to their corporate checking account as the proceeds of the sale of stock. And that money hits their account and is there for their day-to-day operating expenses, which is why it's always a popular option that these large companies talk to their employees about. Make sure you're investing in the company that you're working for. What a lot of people don't realize is that's creating a lot of working capital for those companies. So now that we look at those examples, let's look at the way rollover funding works. Essentially, what we would do for an entrepreneur is we would set up a new corporation for their business. So call it ABC Corporation, which is doing business as, a manufacturing company. Next, we would design and customize a new retirement plan for that new corporation. So now you have ABC Incorporated that has its own company retirement plan. Well, of course, as the owner of the business, you're going to be an employee of that corporation. So just like going from Merck to Johnson & Johnson, you could take your existing retirement funds, money in a previous employer's 401k, IRA, any type of plans that are out there, and roll it over to your new company's retirement plan. And just like going from one employer to another, which this is, there's no taxes or penalties to complete that rollover. The other great thing about this process is that retirement plan that ends up being designed for the company is set up to allow the same types of investment options. It can purchase stocks, bonds, mutual funds, and of course, what's one of the other options? The purchase of company stock. So essentially, as an employee of that company participating in that retirement plan that you've rolled money into, you could go right on, decide to purchase some stocks, bonds, mutual funds, traditional investments, and you can decide to put whatever amount you seem fit into purchasing company stock. And when your plan purchases that company stock, your plan will then own those shares of stock of the corporation, and then the corporation has the proceeds from that stock sale 100% tax-deferred, penalty-free. It is not a loan. It is not an early withdrawal. There is no debt service on this money. That money moves over to the corporate checking account and is now corporate assets. It is 100% liquidity that can be used for any legitimate business expense. So you have the ability to invest your own retirement funds in your own business without tax or penalty. It is a safe, proven plan based on long-standing provisions of the IRS. I can only speak from my own personal experience. At Benetrends, we have completed this transaction over 12,000 times in our 33-year history and have never had a plan disqualified by the IRS. You're using pre-tax dollars to fund your business. It's immediate equity and cash flow right from the start. No debt service, money's in the corporate checking account. So you really accelerate your time to profitability by eliminating or reducing any interest or debt. And the process itself, on average, from start to finish, probably takes anywhere between 2 to 3 weeks. Not to mention, there's a lot of things you can do with these funds. Obviously, you're funding the business, and it can be used for any legitimate business expense, from franchise fees to build-out costs to salaries. And when I mention salaries, that goes to you, the owner, as well. So even when you're starting up your business, and that's one of the biggest fears that people have is, I know I can be successful, but that first 6 or 7 months is really what I'm concerned about. You could be drawing a salary from the corporation to really alleviate a lot of those concerns that you have about having enough money to cover your personal living expenses during startup time. And the money that's used through this process, to go all the way back to the SBA loan, it can be used to provide that equity injection for the SBA. So if we go back to the SBA example, somebody wanting to do a $300,000 project and needing to bring $75,000 to the table, they could do that through a rollover, use that money to go get the $225,000 loan to get to that $300,000 total project. And what's really nice about that is you don't have to touch your cash that you have in your checking or savings account. Because one thing never changes in lending: cash is king. You've already paid taxes on that money, and you can use it for anything in life. So the banks have really had an appetite for this because they see that liquid left in the checking and savings account, and now they have access to these funds that typically are bubble wrapped and are not viewed as liquidity. So it really has become a tremendous form of funding where people have found money where they didn't know it usually existed. And that goes to the example right here. The most common path to success is that combination of using rollover funds and SBA funding. So now that we've covered SBA and rollover, I want to talk about some of the other lending products that we touched on earlier in the call. What's interesting about a lot of the lending products is that they've been around forever. They're there every day, and just people are unaware that they can use them or how to use them. For example, a portfolio loan. So a portfolio loan, best way to think about it is picture a home equity line of credit, where you're using the home as collateral and getting a line of credit against it. Excuse me. A portfolio loan works the exact same way, but rather than using the home as collateral, you're using your stock portfolio as collateral. In a typical portfolio loan, you can expect to get 70 to upwards of 80 to sometimes as high as 90% of the total value of your stock portfolio. So if I have $100,000 in stocks or bonds or any type of portfolio outside my retirement plan, I could get a line of credit for $70,000 against it. The interest rate on a line of credit like that is usually less than 4%. So it's a fantastic way to gain access to funds because if you think about it, you're not liquidating the stocks. It avoids that person saying, I need this money, so I'm going to take my $100,000 portfolio and sell all the stocks to get my $100,000. Well, now I'm paying capital gains tax on that money, and I'm walking away from those investments that I had. And if you look at the stock market and you think about the fact that since World War II, it's returned at a rate at around, say, 9%, and you can lend against those investments at 4%, keep that portfolio and keep those investments, it's a tremendous way to get funding. And just a little side note, this product isn't limited to business funding. People can use a portfolio loan for household improvements, medical expenses, college tuition, whatever it may be. So it's not just a business form of funding. And it works just like a true line of credit. You're only paying interest on the money that you're using, and you could pay it down with certain payments over time. A participant loan. So we talked about using retirement funds in the rollover program, which is a great product, but it's not for everybody. Keep in mind, a lot of people forget that most company retirement plans have a loan provision built into them. The way a loan works, so let's say I'm working at Merck and I'm not leaving the company and I've got money in my 401k that I want to access or use some money from. Most retirement accounts will allow you to take a loan against them for up to 50% of the total value at a maximum of $50,000. So if I have $300,000 in my 401k at Merck and I want to use money from that, I can loan for $50,000. 50% would go at Merck, but I at least have that amount to get to 50. If I only have $60,000 in my 401k, the largest amount I can take is a $30,000 loan. What's great about that product is, again, a very low interest rate. It's typically paid back through payroll deductions, so you can usually just log on to your company account, look at the menu. They'll typically have a button where you can say structure or form a loan. It'll tell you the interest rate. You can pick the payback schedule that's done right through payroll deductions from your paycheck. And what's awesome is that interest that you're paying back on the loan is going back to your retirement plan. So essentially, you're paying interest back to yourself. So those have been another couple areas of funding that, again, they're every day, been around forever. People just forget that they are options. Outside of SBA, rollover, portfolio loans, participant loans, we also see some other forms of funding that have grown in popularity or proven to be tremendous ways to find money where they didn't know existed. Obviously, there's still the home equity side. While it's not pre-housing bubble, we have seen people come back with the equity that they have in their homes, and home equity has continued to play a role in getting businesses funded. And that is a form of funding that could also be used for collateral towards an SBA loan, just like the portfolio loan or participant loan. So that's an option as well. You obviously have conventional loans, so non-SBA, where you're just going to a bank. The pros with that is, there are several options. There's term loans, commercial real estate, mortgages, factoring. Typically a shorter closing time than an SBA loan. The cons with that is extensive paperwork, typically require collateral, good credit, and a personal guarantee. And many don't like to work with small businesses who need smaller dollar loans. So a conventional loan is not really going to look for that. And there are prepayment penalties on a conventional loan, where in an SBA loan, there are no prepayment penalties. So even though there's that 10-year term on an SBA loan, you can pay that loan down sooner rather than later without incurring any additional fees. There's also other forms of funding that are useful for existing businesses and new businesses. Equipment leasing. The pros of an equipment lease: if you need a piece of equipment whose technology becomes obsolete quickly, leasing is usually a better option because you can acquire updated technology more easily. It allows you to conserve capital, therefore potentially allowing better cash flow. It's a simple application. Typically only need the first month's payment up front. Perfect credit is not usually necessary, and there's some potential tax advantages. However, it could also tie up credit so you can't apply for other loans, and leasing oftentimes costs more in the long run, and it doesn't build any equity in the business since you don't own the equipment. And then one other form of funding that's worth touching on that we talked about earlier is crowdfunding. Obviously not something that's existed forever, really popped up over the last 4 or 5 years. For lack of better words, that is going online, posting your business or project, and having multiple people from all different walks of life deciding this is an investment I'm willing to put my money in for a specific rate of return. So what a lot of the crowdfunding companies out there have done are create platforms to show these businesses. So there are companies out there where you can literally go to a website, look at all available projects, and you could see someone that's looking for $500,000, and you can invest you invest a portion of it, and that's how people will get their business. The challenge with that is it's very unregulated, so you have to make sure you're working with a reputable company. There's many out there that are very good. You probably see their ads on TV or hear them online. We do a lot of work with a company named Apple Pie Capital that does a great job. But for the borrower, it can be very expensive money. And typically someone that's going that route, it's because all of these other options do not work for them. Or the business that they're looking for doesn't qualify for that. In the SBA world, you have to be doing a business that's creating jobs. So doing a real estate play or a self-storage business doesn't really qualify for an SBA loan. Passive investments don't work in the rollover world. So there are specific types of businesses that will work for crowdfunding. But again, the most important thing is to work with a reputable provider. And again, keep in mind it can be expensive. Sometimes it can be and I think interest rates can rise up to as high as 8% on the money. So you're not often going to find somebody that has access to these other programs go that route. This is usually a route that they go when all other routes are exhausted and not working out for them. So I do appreciate everyone's time. I know we covered a lot of different topics. Again, the most important thing is to know there are resources out there. It's not just the Benetrends. You have your SCORE relationship. They have all the information on so many different products and advisors throughout all of the different channels to get the information that you need. We love working with the SCORE offices. We love working with entrepreneurs that are looking to better their business or get into business, and we're happy to take our clients through all the different programs, any type of pre-qualification. With that being said, we're about 40 minutes in. I want to leave some time for any questions that the group has, so please feel free to utilize your chat box, or Dave, if you're getting any questions on a separate channel, please feel free to read them out to the group, and I'm happy to address them.
Yes, thank you, Eric. It was very, very insightful and helpful and informative. We do have a question, and this person has asked, can you share how a spouse's income is viewed to elevate post-transaction liquidity concerns?
It's a great question. So anytime somebody's going for an SBA loan and the post-closing liquidity aspect comes up, when one or both members of the family are keeping their jobs, it's going to make them more attractive. That's without question. However, banks don't view salaries as post-closing liquidity because it's not available liquid. If you say you make $60,000 a year, you don't have access to that 60 today. It's future payments. So while they like to see that the spouse or one of the individuals is employed, and it will lower maybe what they want to see on a pure liquid basis because they know that cash is coming in and they have ways of covering their living expenses from that, but it's not going to be well, they don't have any post-closing liquidity, but this person has a job, so they're fine, because that's not available liquid. If your monthly living expenses are $5,000, but you only get paid in salary $4,000 a month before your taxes, it's still not going to give them that comfort level. It definitely helps. It'll definitely lower what they're going to look for on a pure cash basis, but it doesn't eliminate the need by just remaining employed.
Thank you. I hope that answers your question. If not, let me know. Another question, any info about grants? How may they be viewed in the 70 to 80% loan amount or 20 to 30% personal equity?
It's a good question. I am not an expert on the grant side. What I will say is when looking to get an equity injection for an SBA loan, it usually can't come from a form of lending that's being required for you to pay back with cash on hand. So I mentioned you can use a home equity loan to be the equity injection for an SBA loan. That gets tricky because they also want to use the home as collateral. But you can use the portfolio, and the reason they look at those is that those are tied to specific forms of collateral. What you can do is get a loan, a straight loan that requires you to pay it back out of personal assets, and then use that as the equity injection for an SBA loan. So you can't get one loan to get another loan. For example, we had a candidate that said, I'm going to get an equipment lease and use the money from the equipment lease to get an SBA loan. That doesn't work. It has to be a form, if you're going to use a form of lending to get your equity injection, it has to show that that loan is collateralized outside of your personal assets or cash on hand to pay back that loan.
Yeah, I think also, Eric, she may mean, and I don't want to read into her question, but I guess my question on that would be, if I have a grant, does that count as equity to a lending agency? If I
Again, not
receive,
being the expert on the
okay,
grant side, I'm sure there's all different forms of grants, and if that money is given on hand, also grants are given that are given based on the fact of being used for additional lending. It's definitely something we could look into. Great question. Have
okay,
not run into that before.
okay.
But the same thing comes up with, if somebody gives money from friends or family
Yeah, yeah,
for
yeah,
the equity
yeah.
section on an SBA loan. The bank's just going to want to see where that money is coming from, and if there's money that's required to be paid back, how is that going to happen?
Okay. I think that's a good answer. Um, Another fellow has asked, what about SBA loans for less than 150,000?
Yes, as I mentioned earlier on, SBA loans can go from as little as 50,000 up to 5 million. That specific program is for the 50 to 150. If you're looking for some type of SBA loan for under 50,000, then what I would suggest there is going to the SBA's website and looking under the section that talks about microloans. Microloans in the SBA world is what would be used for, say, under $50,000. And what the SBA's done is I think they keep a list on there of all banks that participate in the microloan program, but they're not very common.
Good. Great question. Thank you. Well, I think that is the extent of the questions we have. I'm pretty sure on the next slide that Eric has given the benefit of his contact information, and if you don't have a chance to write it down, certainly when you look at it online, you can make note. I'm sure he'll be happy to answer any specific questions you may have at any point. Please keep in mind that, as you may or may not know, SCORE is an all-volunteer organization made up of retired and semi-retired former executives and business owners, and our mission is twofold. One, provide education for small businesses and entrepreneurs, and two, which is really a service you should think about if you need it, is free face-to-face, one-on-one mentoring. So if you're looking to start a business, you have a business, and you want to grow it, you're having challenges, feel free to contact SCORE Bucks County and arrange for a mentor who will work with you and give you advice on your business. It's as simple as that. So again, thank you for attending. Thank you again, Eric, for your presentation. Watch your email for the link to the recording. Next Wednesday, we have another fascinating topic on how to use Facebook, which everybody's familiar with Facebook as a social media. It's also a great way to grow your business and attract customers. So we'll be sending an email about that as well. And unless there's further questions, we shall say good night and thanks again. So we're out. Thank you, Eric.
Thank you, everybody.
Okay, we are finished.
All right.
Yep, good. All right. Stop recording.